SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Baffi Bocconi e-lecture on conceptions of money in the digital age. The invention of digital ledger technology, the creation of private digital currencies, and central banks' ongoing projects to create public digital money, CBDC, raise fundamental economic questions about the natures, the features and functions of money. This SUERF Baffi Bocconi e-lecture brings together leading experts in the field to discuss key issues based on economic principles against the background of various conceptions of money in the history of economic thought. These seemingly theoretical approaches are key for understanding the options and the choices to be made in the design of private and public digital money and the consequences arising from such choices. We have a top speakers lineup today for you to discuss these issues. We'll start out with Professor Michael Peneder, Senior Economist at the Austrian Institute of Economic Research, who just published an interesting SUERF policy brief on Austrian conceptions of money and the rise of digital currency. Then Raphael Auer, Senior Economist at Sveriges Riksbank, will summarize the findings from recent research published in the SUERF policy brief on revisiting the properties of money. Then Ulrich Bindseil, Director General, DG Market Operations, European Central Bank, Professor at TU Berlin and SUERF Fellow, will offer the views from the ECB based on his leading involvement in the ECB's preparatory work for the e-euro. And last but not least, Raphael Auer, head of the BIS Innovation Hub Eurosystem Center and CEBRA's president, will provide us with a global perspective given the BIS's leading involvement in the research on and the conception of digital money and CBDCs worldwide. I'm very pleased to welcome Katrin Assenmacher, Head of Monetary Policy Strategy Division at the ECB, who herself works intensively on this topic, who is going to moderate the discussion. Without further ado, I hand over to you, Katrin.
Thank you very much, Ernest, and welcome to everybody. And I'm really excited to moderate today's panel, and I'm very much looking forward to the contribution. I would like to start immediately with the presentation, and the agreed order is that Michael is starting off.
I really very much appreciate the opportunity to speak to this audience in this e-lecture series, even more so since my professional background is in industrial economics and innovation research. And given that background, I was somehow naturally drawn into the orbit of Schumpeterian ideas and the Schumpeterian topics, the problems he liked to address. And it was in the course of the past years where I studied various aspects of Schumpeterian economics, so to say, innovation, competition, entrepreneurship, and of course, venture finance. And in the course of those years, I became increasingly aware that most Schumpeterian economists are missing out a major ingredient and a major part of the Schumpeterian oeuvre, in that they do not really, they tend not to recognize that Schumpeter's theory is first and foremost a monetary theory of economic development. And it is this monetary aspect that I tried to link up with this book publication, which I did together with an economic historian from the Vienna University of Economics and Business, Andreas Resch. And yeah, much of my thought and my entry. So I thought it is fair to say, to explain the entry point where I come from when I address issues that you might be equally familiar, but coming from different angles. Of course, I'm not going to give a lecture on Schumpeter, but Schumpeter is part of the bigger picture that I want to discuss today. Given the short time, I just focus on 4 ideas which I've picked among the various monetary conceptions of money that come up in the tradition of Austrian economics, broadly defined. So in this sense, also including Schumpeter, who would not be a member the Austrian school in a narrow sense. But of course, this was also his intellectual upbringing, and much of the ideas are important to understand his monetary approach to economic development as well. I pick 4 ideas with 2 main objectives. One objective is to demonstrate that the Austrian conceptions of money are much more diverse than generally perceived. And the second objective, of course, is to demonstrate that they have a high actuality. They're very relevant to many of the topics that are still important and that have become increasingly important in the past years in the course of the process of digitalization. So I've picked 4 ideas. The first one is the one you're most familiar with, so I will just briefly touch upon it just to create, so to say, a common ground for that. That is, of course, Karl Menger's conception of money as the outcome of an evolutionary institutional process of spontaneous order social coordination, which is a common theme in all the different Austrian conceptions of money. And I think later on I will emphasize the diversity of these ideas, but this is the common ground that all quite equally share. And I don't go into the details in this 10 minutes I have for this part of the lecture. But the main point that comes out of this analysis is that money in its origin is a social and not a state institution. That's something he made much effort and I think quite successfully tried to demonstrate in the case of how money developed up to his time. This perspective is shared by all the Austrian economists and associated kins, I would say. Among those kins is Schumpeter. And he expressed the attitude, the general attitude in the Austrian conceptions of money in a critique on Knapp's state theory of money, in which he very poignantly declared that money is as little and in no other sense a creature of the law than is any other social institution such as marriage or private property. So what he wants to say is that legal provisions are, of course, an important part of economic reality, but they are comprehensively only, and they must be understood on the basis of the social nature and the economic functions they have to fulfill and they try to regulate. So that's one core common theme among all the Austrian conceptions, that it's social coordination and economic functions, and the legal provisions are a consequence and an outflow of them, which of course then have a big impact on how they work out in practice. But as an economist and from a theoretical perspective, one must start with these social functions. A second idea, which I think is not so frequently acknowledged, few people probably are really aware of, is that Friedrich Wieser was one of the Austrian scholars who very early on recognized and declared a certain tendency in the history and in the historical evolution of money. And he pointed at an ongoing process of dematerialization in the evolution of money. Now, from today's perspective, that doesn't seem very spectacular, and also for that reason, I will not spend much time on that. But we should remember that Friedrich Wieser stated this position and this view at a time when the gold standard was the epitome of sound money. And so at his time, he was considered quite heretic with this vision and with this view. And of course, in the historical records, one can easily start, for instance, with the debasement of coins up to the fiat money becoming common since the 1970s. And if one looks at this long-term process of increasing dematerialization, which has a lot of intrinsic advantages in terms of concluding transactions and recording transactions and all that. And if one looks at it in this long-term perspective, then digitization is just another logical next step. It almost seems natural that this is the next step where the money evolves to, and it's the private sector, the private initiatives that have started the process clearly, and it should not come as a surprise if the public sector, the public institutions follow up on these developments. For historical accuracy, I would, of course, add that this historical trend and evolution is not that linear that it might seem on this simple statement. We know from the historical records that the very early representations of credit were symbolic, and long before metals and coins emerged as a medium of exchange, we had these clay tokens, clay bull, etc. So it was more this credit, this historical record that more supports the kind of credit theory of money than the other way around. And in the end, also, I would say that this process doesn't have to be linear in the sense that it's all ever going to dematerialize, because we do face the challenge of maintaining and maybe increasing the resilience of also the payment systems and the whole monetary system. And then I do believe at least that physical or hybrid forms of cash will maintain to play an important role in that. That goes beyond the mere transitory effects of, let's say, digital skills and social inclusions, which could be temporary in the sense of there should be means to overcome these problems also in a fully digital system. But there remains the issue of resilience and the possibility of, for example, electricity blackouts. And policy has to think about that and try to keep and maintain a fallback option also in the long run, which would go somewhat counter a linear interpretation of this long-term evolution of money. The third idea I wanted to pick as for this introduction into this e-lecture is the conception of money by Schumpeter himself and how it links up to the idea of a universal ledger. So you might be familiar with Schumpeter's monetary theory, which has the characteristics that it puts much emphasis on the endogeneity of money. It puts much emphasis on the non-neutrality of money. So it goes a long way to explain the finance growth nexus, how monetary phenomena affect real production. These are the better known part of it. Behind these better known part of the Schumpeterian monetary concept is his idea or his vision of money as a claim ticket to the social product. So that's a very broad, so to say, phenomenology of what he considers the essential part of what makes money distinct from any other economic institution. And in that, he emphasizes that the universal ledger of economic transactions is its purest form and logical conclusion. And I think this is a quite different approach and way to think about money that did not have much impact or following in the past decades, but with digitalization and with the developments here, it's becoming ever more relevant and more plausible and fitting to comprehend what is currently happening. So just to give a brief quotation from Schumpeter himself, it was the generalized notion of his current account relationship. That is the idea that everyone's economic acts are recorded on a real or imaginary current account, is so essential, useful, etc., so that he calls it the basic concept of monetary theory. That was his vision, that was his idea. It did not gain much traction at his time, but I think it's increasingly becoming a good point to understand many of the developments throughout economic history and the history of money and finance, but especially now with regard to digitization. And if you just think about, of course, it would be too simple to associate that with distributed ledger technologies. So there is a kind of semantic overlap, but behind that, there's a close relatedness. And of course, the new developments go much beyond this initial vision. If you just think about distributed ledger technologies, there the meaning of the word universal is an entire different dimension, or adding another dimension. Just thinking that it's not one account which has a universal record of all those transactions, but it is actually each node that should hold a real-time copy of the general ledger. That's not just for some policy reasons or for some general view of how society should be equitable or whatever, but it is part of the technology itself. It is this redundancy, which in this system would secure the integrity of accounts. So it's very deeply ingrained. And even though we know that in practice this is not very resource efficient, and there can be, probably will evolve more practical means to handle scalability and other things in practice, it is an extremely intriguing theoretical aspect of this new technological development.
Michael, if I can ask you to come to an end, so we are over the 10 minutes already.
Okay, then the final point is again one that is well common. People know about it, so I can be short. It's simply the issue of private currency competition. Don't need to point much about Mises and much of these libertarian ideals that were taking up in this Bitcoin movement as a kind of reincarnation of a digital reincarnation of gold. More important, I think, for the theoretical and the further evolution of money is the close connection of Friedrich Hayek's idea of free competition between private currencies and the evolution of the stable coins of various kinds, and the idea of Hayek that in a system where you would abolish legal tender and have free capital flows, it would simply be the best money, let's say the best stable coin that would survive, and that would be to the general benefit. Then, of course, one has to add the critical note that the idea as such is quite intriguing, but what Hayek ignores, and I explained it more in the note, in the research note, is the kind of network effects we know from industrial organizations, especially with digital platforms, where the opportunity to contract in one's own unit of account would just be another means to increase very large the strategic discretion and opportunities to have to increase market power of big tech platform companies. So in the end, one could not and should not be optimistic that this market would be contestable, and this brings in the public sector again, either in the provision of one's own digital currencies, as we will discuss today with CBDCs, or with the regulation of fintech, etc. Thank you.
Thanks a lot, Michael. And then I would move on to the next speaker, who is Isaiah. So Isaiah, the floor is yours.
Thanks, Katrin. So thank you for the invitation to present. The paper I'm going to talk about is entitled Revisiting the Properties of Money. So I'm Isaiah Hull. I'm a senior economist with the research division of the Riksbank, and I'm working on this project with Or Sadeth, who is a theoretical computer scientist at Ben Gurion University. So Or works on quantum and classical cryptography, including their application to financial technology like cryptocurrencies and quantum money. And incidentally, if you have an interest in learning more about quantum money, Or and I have a paper with two quantum physicists entitled Quantum Technology for Economists, which we released as a working paper last year. And we provide an introduction to quantum computing and quantum money in that paper. There's much more low-level detail if you're interested. Okay, so the intention of this paper is to provide an update to the canonical framework of the properties and functions of money. The properties and functions of money are described in essentially textbooks by Jevons and Menger in the late 1800s. There's of course a lot of work that precedes this, but the discussion really crystallizes here in the sense that if you were to ask a central banker or a monetary economist, what are the functions and properties of money today, they would refer you to functions and properties that are defined in Jevons and Menger, and not really anything afterwards, unless they're currently working on CBDCs or cryptocurrencies. So our intention is to revisit this framework and to see whether it needs to be modified in light of the digital era. So can we use the properties, the Jevons and Menger properties, to meaningfully distinguish between digital currencies? Or do we need to expand the language that we use to describe money in light of the changes we've seen over the last 30 to 40 years? So in particular, in doing this, one of the things that we need to do is reconcile two literatures. So in the past, this literature about the properties of money was mostly contained within economics journals and textbooks. And now we see a large literature in computer science where the properties themselves are actually being constructed. And so there's a need to create a common terminology between the two disciplines that's still sufficiently general in the sense that it can fit within an expanded Jevons-Menger framework, but also granular enough that we can actually say, what are the specific differences between private bank money and a stable coin, for example. In doing this, we also try to evaluate the performance of different forms of representative money according to the expanded framework that we propose. So I'll show an example of this. So this is showing part of the table that we use in the paper to perform this classification. So what we do is we take the functions of money, including a new one here, which I'll talk about on the following slide that we propose. And then we categorize each property according to its primary function. And then we take a number of representative forms of money, which we think, I mean, we tried to be as exhaustive as we could, but certainly there are more types of money that you could add. And then we identify how well they satisfy each of these properties. So, we talk about commodity money, physical coins and bills, central bank reserves, bank deposits, CBDCs, in-game currency, cryptocurrency, different cryptocurrency varieties, like ones with decentralized applications, ones that are privacy oriented, and also two different types of quantum money schemes, private key quantum money and public key quantum money. Okay, so I'll start by talking about functions of money, because here we don't actually modify the Jevons-Menger framework very much, because we find that it's largely sufficient to describe the uses of digital forms of money as well. So we maintain the four canonical functions: medium of exchange, standard of deferred payment, store of value, and unit of account. But we do actually add one additional function to this framework, which is a societal or regulatory objective. And this is something that, of course, predates digital currencies, but becomes increasingly salient with digital currencies because the number of design parameters that we can control is much higher with digital currencies than it was with preceding forms of currency. So if we think about commodity money, we're choosing over a set of commodities which have largely fixed properties. When we move to paper bills and metallic coins, we can do engineering on the properties, on the materials properties, to try to make it more difficult to perform counterfeiting and to improve durability. When we move to fiat currencies, we now have control more directly over the stability property of money. But when we move to digital currencies, we're really restricted by information theory. So the amount of, the degree of control over which we have over design really expands. And we see as a consequence of this, a movement towards creating forms of money that have a specific objective in terms of either society or in terms of regulatory purposes. So for public money, for instance, we see the idea of embedding mechanisms in the money itself to try to facilitate things like anti-money laundering compliance and the disruption of terrorism financing. And then when it comes to private forms of money like cryptocurrencies, they're sometimes built with the intention of incorporating systems of censorship, of resistance, to try to prevent any one individual or government from blocking an individual from transacting with that form of currency. Now, what's notable about this set of functions that we propose in the paper is that these can actually be primarily burdensome to users. So it could be an objective which attempts to provide a public good to society at large, but is actually primarily a burden to those who are using them. So it's actually, that's distinct from the other functions of money which provide concrete benefits to users. We say a lot more about the properties of money, in part because we think this is the place where the canonical framework is lacking in terms of its ability to describe digital forms of money. So if we think of, say, multiple forms of digital currency, all of which are uniform with the euro, like a stable coin or private bank money, then we might ask, how can we distinguish between these forms of money within the Jevons-Menger framework? Well, we might be able to do it, if we really shoehorn things into the properties that they propose, but we can't really do it with any meaningful degree of precision. So I think we give up too much to try to maintain that high level of generality. In particular, if we're thinking about a competition between, a number of digital currencies which are all, uniform with some unit of account like the euro or the dollar, the margin of competition between those currencies is likely to be over new properties, namely the ones that we discuss in this paper, which are introduced in the computer science literature and which have been discussed also recently in the economics literature. So things like throughput, if we're comparing private bank money to Bitcoin, well, Bitcoin globally within the network can only process a tiny fraction of the number of transactions at most in a given interval of time. Latency is quite important. So how long does it take? How long does it take for a transaction to settle? There are substantial differences between different types of digital payment, and that can be decisive in determining how well we're able to use them in things like e-commerce. Untraceability is one that really arises as a consequence of account-based forms of money. So if we're using commodity money or we're using metallic coins, traceability is low. We move to paper bills. Now we have serial numbers, which provides a form of traceability. When we move to private bank money, we have automatic, digital trails that are created for all transactions, which provides a high level of traceability that can then be used, to provide convenience features, to do money laundering detection, and so forth. And so now we think of traceability as a feature that can be, or as a property that can be encoded in forms of money. Reversibility is another, modern digital feature. So can I do a one-sided reversal of a transaction, or do both parties need to agree? Backup is another one. So, I can't back up my commodity money like gold. I can't back up, my physical paper bill, but in principle, with some digital forms of money, I can store a copy of the bill state, and then I can back it up in the case of loss or theft under certain circumstances. Now, one of the things that we emphasize in this paper, which I think is discussed more in computer science and more among private currency producers than in the CBDC literature, is the many hard and soft trade-offs that we face as a consequence of this increased capacity for design that we now have in the digital era. So even though we can encode many more properties, a larger variety of properties into money, we can't do all of them the best. And in fact, we have to pick between them. Things as basic, as fundamental as information theory, tell us that there are explicit trade-offs between some of these properties. So for instance, if we want a form of money that provides a high degree of reversibility, in the sense that it's very easy for me to reverse a transaction once I've discovered fraud or misrepresentation, well, that necessarily means that some latency needs to be built into the settlement time. I can't be the best, my money can't be the best at both of those things. It can't be both very reversible and not very latent. We have to pick between those two. Another trade-off is between local verification and backup. So local verification is a concept that's formalized in the quantum money literature by Ernest in 2009. And what local verification means is that I can determine that a unit of money is valid, that is not counterfeit, without communicating with a trusted third party, like a central bank or a payment network, or even a digital ledger system. Now, if I want to be able to perform local verification, then I can't also have the ability to perform backup. If I can do those two things in combination, then there's a trivial way for me to perform counterfeiting. Another trade-off is between traceability and financial crime prevention. So if I want to have a form of money that's a substitute for cash because it has good anonymity and privacy properties, that probably means that it's going to be very difficult for me to prevent financial crime as much as I can within the existing system of private bank money, where there's much less privacy and anonymity.
Isaiah, I also would like to ask you to be mindful of the time.
Okay, so I'll conclude here quickly. So I'll say in the paper is very much a combination of a reference and a literature review. So we don't have strong conclusions, but there are themes throughout the paper. And so the first is that we think that this Jevons-Menger framework is still very relevant for thinking about the properties of money and which types of money might perform well in the emerging era of currency competition. But we think the Jevons-Menger features may no longer be decisive. I mean, we may have multiple uniform digital currencies that are competing, and so stability is off the table. They're all equally as stable. but they have different properties, like the ones that we've discussed in this presentation. And those will decide who wins the currency competition, and they can't meaningfully be described using the language that we currently use, the framework that we currently use in economics, which comes from the late 1890s. We also think, that there are societal and regulatory objectives as new function that we highlight in the paper. It's very likely that this can, impede the adoption of both public and private currencies. And so this, this has to be implemented thoughtfully. So, if we want to have good, AML properties and counterterrorism financing properties of a public form of money, we have to be mindful that then also places a burden on all of the other users of the form of money that may make it perform poorly in a currency competition. Then finally, it's unclear how CBDCs will perform. In this era we're seeing of heightened currency competition. It's not clear what a CBDC should be other than public and digital. I mean, it's produced by a central bank, so stability will probably be an important property. But again, we'll have multiple uniform currencies, and so they'll all be equally as stable. So it's not clear that that's decisive in making it, the chosen medium of exchange. It's also not clear if central banks even want to regain control over the medium of exchange function, as this might cause disintermediation in the financial sector. And I'll stop there.
Thank you very much. And then I would like to move on to Ulrich, who will also look at similar issues and in a historical context, if I'm right. So
thanks a lot for inviting me and for allowing me to discuss a bit those two very nice papers. And indeed, looking back at history and at the history of economic thought is very relevant if we want to understand our work on CBDC and what we need to look at. Introducing CBDC is not the first metamorphosis of money. There have been previous ones, and those ones were also, let's say, not easy. I believe they happened with, a design in facing trade-offs and with a lot of positive expectations and intense learning and gradual change of belief. And here I want to quote this thing from Goethe in German in the original, but with translation, which is, I think, always a topic if we study the history of money and the history of thought on money. A lot of things have been looked at beforehand, and so what Faust, I think it's, I don't know, I guess, I'm not even sure who says it in Faust, but what is said is, okay, who can think something clever or something stupid that has not been thought previously? So regardless of what we say makes sense or makes little sense, it's pretty likely that someone else has said it in the past, and that applies in particular, I think, to many also 19th century authors, actually, that they have maybe not thought on what has already been studied. And us who fall back on those 19th century authors, of course, then inherit this problem that they have worked on a certain perspective. And there is this tendency to rely so heavily on those authors. Some of those things I will say are in a section 2.3 of a short paper, a short section in a short paper, but there you find also some references. So first, just a few remarks on Michael's paper. I mean, I'm not an expert at all in Austrian conceptions of money, and I think the presentation was excellent. I understood some points better than after reading maybe too quickly the paper. I mean, just here 3 ad hoc points, and as you will see, I come very much from this topic that the 19th century has not been the beginning of the history of money, and by ignoring the previous development, one just follows, the trap of the 19th century. So the dematerialization of money is indeed, a long-term trend. That's true, but what is often forgotten is that the Giro banking and public Giro banks as of the 15th century, were advanced in the sense that they run a central ledger. So you may call that I mean, they wrote this, the central ledger was in paper, if you want. It was written on paper, but apart from that, it is, you could say, as dematerialized as a central ledger run on a computer. A computer is also material. So in this sense, you could say we had this dematerialization of money. Of course, one such dimension is the non-convertibility that was also mentioned by Michael. But there also, non-convertible public money is also not exactly new. So the Chinese state paper money, if you want, is not convertible at a bank into metal, and also central banks in the 18th century, some suspended convertibility for decades, and so the value of money floated a bit independently of the original theoretical promise of convertibility. So again, the universal ledger idea that Schumpeter maybe projects in the future, I think was one of the main achievements of the public Giro banks in the 15th century. And some remarks on Isaiah's paper. So Schumpeter, I mean, those three functions of money that you assign to Jevons and Menger, it's true. I mean, it's often assigned to Jevons and Menger, but already Schumpeter noted, to then come back to the Austrian Economist, that the three, main functions of money can be traced back to Aristotle. I mean, he referred to them quite explicitly, and Jevons and Menger again are 19th century guys. So, and Jevons is, in addition, I would say, a theoretical economist, and of course those Jevons, is not the one who will look at trade-offs. I mean, their endeavor was to simplify, to extract, the theoretical aspects, the simple aspects for, suitable for an economics book, and therefore they didn't care about trade-offs. That's I think the main reason. And if we want to look for trade-offs, we have to look elsewhere. And in view of the hundreds of years of public Giro banks offering means of payment, there were all those trade-offs were there. No, I mean, just to mention throughput, latency, traceability, and backup, those were all prominent topics over centuries. If you run a public Giro bank, the throughput and latency, the settlement mechanisms, the timing in the day, when you can do what, when you can settle, when you can retransfer money, that is all very practical topics you encounter. So the place to study this is probably to look at the original texts, the mandates, and the literature of those centuries, how those problems were handled. Of course, those bankers at that time, they were not economists. They had other things to do than to write about it. So they just run this business, but it doesn't mean that running a concrete business was not always full of trade-offs and of complexity and detail, in the same way as you have it, of course, if you look at the modern digital currencies. And also they had societal and regulatory objectives. I mean, those public Giro banks were all based on legislation, on charters, which formulated policy objectives. So it's far from new that such objectives are also part of the design of money. And on this slide, I also quote someone that's an author, also, and early 20th century, who notes this point that banknotes have been, are the topic of the 19th century. The love of gold has been replaced by the love of the banknote for its own sake. But there has been, beforehand centuries of Giro banking. And this is, just the early banks, the pre-18th century banks, public banks, which I would say fulfill a meaningful definition of central banks, in the sense they were based on a public charter, had a unique role, and issued a dominant means of payment. And the first one that issued banknotes came only in 1657. Stockholm Banco, and it defaulted after 5 years because banknotes were new and they were not well understood yet, and there was a lot of exuberance around them. Also, turning to this from history to the history of economic thought, there were also authors before Jevons and Menger who went deeply into the nature of means of payment and the role of central banking. There were lots of English authors in the 17th and then 18th century, and maybe they wrote a lot because they did not have a bank. Why the Dutch had a bank, the British had no bank, and they tried to launch a bank and therefore wrote about it. And this, this literature is very, early, of course, and the formulations are a bit unusual, but I think they all circle around the merits of central bank money. And they had, they came from the Bank of Amsterdam, which was a pure giro bank and the dominant such bank in the 17th century. And then there were others. I keep it short. And again, so deposit banking is older than banknotes. You can see this reproduction of a coin on the left, the idea of the giro bank, the liquidity pool that is then circulating is far earlier than the first banknote, which appeared in 1662. And maybe I skip this. This is just balance sheets of those early banks in the 18th century. The lower part is on the liability side, deposits versus banknotes. So you can see that, there were the pure giro banks, the first two, and then the Bank of England and the Swedes who had a mix. They issued both types of liabilities, but also deposits and giro deposits, which could be transferred. And insofar, and access was granted to a broader set than today, so not only to banks. So all the issues that you have when you design a ledger-based payment system were already there also for those. And then, of course, I think that's really nice, Isaiah, what the comprehensive mapping of properties and matching them with different forms of money. And here I just do the same, and with some emphasis on history. And I think what also this table illustrates is that not so much is new. Of course, digital is new by definition, because we are only turned digital a few decades ago. But many other things are really not new. We had different types of issuers. We had ledger-based system, single ledgers, multiple ledgers. We had distributed ledgers in some sense. We had attempts, to have remote access to ledgers. And we had different legal bases and different connectivity, if you want, online, offline, and presence. So just to say, a lot of things have happened and have happened before the late 19th century. And by relying on authors only from the late 19th century, we follow, what they did, namely to, have this 19th century much in mind. And we miss all the policy work, all the fine-tuning, all the trade-offs that ledger-based central banking always offered. Yeah, that's all from my side. Thank you.
Thanks a lot, Ulrich. So then we can move to our last speaker, who is Raphael, and I guess you will be more in modern times.
Thank you very much. It's a great pleasure to speak here today. I will indeed sort of ground the discussion a bit, or at least aim for grounding the discussion a bit in from a policy perspective and from what central banks are actually doing. Let me add that I'll be speaking on my own views and not those of the BS. We've discussed this classical idea that money is a social construct. You expect it in payments, expecting that somebody else will also accept it in the next transaction. And with this social concept, it becomes an alternative to a public ledger that records the history of all transactions. And we've seen this in a long historical context. We've seen it formalized in Koch-Lakota 98, and we now are having debates on whether sort of these classical views of money, how sort of they will reflect upon the nature of money when we develop CBDCs. And we're also, of course, seeing this against the backdrop of a digitizing economy and advances in computing and cryptography that give rise to new forms of what this ledger could take. Want to, throw in a little side thought. We get carried away by technological perspectives, but we should always think about the economics too. So it's not that we have many nodes that store certain data that is so important, but it's really about the incentives of the whoever control these nodes and sort of why they might update the ledger correctly. But in this debate, right, there's certainly a lot of specific attention on a new form of public money, CBDC, and that's really what I want to focus on today. Will they transform the nature of the monetary system and the functions of money? And I want to really take a very simple perspective, take a step back and look at the motivations that central banks have when they think about issuance, and how these shape the pursuit designs. And this is important when we think about money as a ledger, because then we need to think about information structures. And where central banks are coming from gives rise to a specific form of designs, and this will sort of leave much of the information structure the same as we have it in today's financial system, even with widespread use of a CBDC. So in the end, we could see a much more limited effect. Let's start with sort of the core motivations for CBDC. Central banks have certainly been thinking about the idea of CBDC before the pandemic, but that has really given it a big kick. Use of cash and retail transactions had been declining, but with sort of the pandemic, that just fell off a cliff. Here you can see in the middle panel just how people searched on search engines like Google, terms like virus and cash. Those are terms that pre-existed before the pandemic, but and they actually, if it wasn't for the scale dictated by the COVID pandemic, you could see little spikes in earlier pandemics, but it's just, unprecedented in the scale. And then that leads to a situation where you can be in certain cities around the world and you can pay with cash. And that puts, central banks to a fundamental dilemma, because cash is for many their first product, the raison d'être, and they need to think about a digital complement. And that also shows up in the motivations that central banks indicate when they're asked about why would you consider issuing a CBDC. The CPMI, the Committee for Payments and Markets Infrastructure that the BIS hosts, has an annual survey on motivations for CBDC issuance. Here I'm looking at the answers for retail issuance, and we see sort of that it's really about domestic payments, robustness, and efficiency. And that's a universal trend. And then in emerging and developing markets, it's also about access. So really, this is really about finding a digital complement to cash. And this and not much else. And that has also been reflected in a document on foundational principles and core CBDC features that the BIS, together with the world's leading central banks, including the ECB, has issued in 2020, that really lines out what are the foundational principles if we were to issue a CBDC. And these really, they circle in on promote innovation and efficiency, but they also circle in on do no harm, do no, consider the side effects, and ensure coexistence with what exists today, and that is cash and commercial bank money. So, and there are two sides to how these principles will affect CBDC design. One thing, and I'm going to be very brief here, it has been talked a lot about. Ulrich actually has a number of papers on that, is to mitigate the systemic impact. Here we see on the graph how much cash is in circulation in a number of economies and how that compares to the amount that people deposit on bank accounts. And we can see, right, there is at least an order of magnitude difference. And because cash is sort of is very usable as a means of exchange, but it's not a very good store of value when compared to bank deposits. And CBDC can be designed accordingly. But there is another dimension, and that's the operational one, and that relates really again to money's role as a ledger to the information structure. Let's briefly remind ourselves what a retail CBDC is. Today, we have two forms of central bank money in the hands of consumers. Sorry, two forms of money. One is not the central bank money. Cash is direct central bank money. It's a direct legal claim on the central bank, and there is no intermediary balance sheet in between. However, today's electronic money is always a claim on an intermediary, and that intermediary then might back some of that up at the central bank, but it's always an indirect claim. And a retail CBDC would combine these two features and be a direct legal claim on the central bank, but in electronic form. So just to remind ourselves really, what is the concept of a CBDC? And as a concept, it is unrelated to technology, but of course, in a practical payment system, there needs to be a technological implementation, and a direct one that people sort of have in mind intuitively when they think about a CBDC, and that's a starting thought that central banks maybe had some years ago, is that also sort of the information structure mirrors the claim structure. So then you would end up in a central bank operated payment system where the information flow is combined with the legal flows. And here, for example, the central bank operates not only sort of the onboarding of clients, but it really has every transaction going through its servers. But of course, this would lead to a fundamental shift in the monetary and financial system, and it would crowd out the private sector, and it would overburden the central bank. So that's why central banks actually, and I'm going to show the stock take in a second after going through the context, are going for different designs. They're going for two-tier designs where sort of the information structure is separated from the ownership structure. And that sounds a bit odd, but we just have to remind ourselves how cash works. A banknote in your hand is always a claim on the central bank, even though the central bank doesn't really know that you hold it. It's only at the point where somebody shows up at the central bank office, for example, a commercial bank, and they say, we have this many banknotes, can we sort of rebook this? Then is when this sort of, that is the proof that the legal claim has these and these owners. And with the CBDC, the information structure could be similar. So here I'll be talking about a fully intermediated structure where you do not have any intermediaries with balance sheets. So CBDC claims are always on the central bank, but sort of the record keeping at the retail ledger is always done by payment service providers. And these only pass on wholesale balances to the central bank. So you have firms, those are not banks, those are like payment service providers, they could be tech firms, they onboard, they do the know your customer and ongoing due diligence, they execute transactions between their own clients directly, and if there is, there could be of course multiple PSPs, if there is a payment between those PSPs, then it will go also through sort of the server of the central bank. And in that way, easily the information structure can be very different from sort of this conceptual structure of what is a CBDC. And in fact, when you remind yourself about how the information structure works today, it looks exactly the same, with commercial banks having liabilities to retail users and having wholesale claims on the central bank.
Raphael, can I also ask you to wrap up soon?
So yeah, 2 minutes. There could also be intermediate designs where the central bank receives more information than it does today and serves as a backup to the payment system. When we do a stock take of what central banks are really pursuing, we can and we have that at the BIS website. We update that every quarter. We see that really what central banks are going for are these two-tiered architectures that really give a lot of operational involvement to the private sector, and by that also preserve the information structure that we have in today's system. So let me conclude here. We see a great deal of heterogeneity in approaches and designs across countries, but I want to come back to sort of what Isaiah said before and underline it. So he said that from a technological perspective, we cannot sort of incorporate all these potentially viable features like undoing a transaction, like preserving privacy to some extent, but some partial auditability. That's already a technological concern. But much more important is that that's not even on the central bank radar. For central bank, the policy objectives are much simpler. They just want to have a resilient payment means that sort of resembles cash in digital circumstances. And that means that they will be a means of exchange rather than a store of value, that they will coexist with cash and bank deposits, and that they will feature an important role for the public sector, private sector. And sort of given all that, I think we should sort of also consider that if they're not sort of changing the system at large, and if they're preserving the information structure, they're also going to sort of have limited effect on the nature of money. Let me stop here. Thanks.
Thanks a lot, Raphael, and thanks a lot to all the speakers. So I think these were excellent presentations that give a lot of food for thought and also food for discussion. Let me start with a question that has been submitted by Deepan Mantri to Raphael. So, do central banks expect CBDC to have all properties of cash, but in a digital world? So I think this is related to these conceptions of money. So you're saying it's a complement to cash, but we probably also want to address some of the ongoing trends that Isaiah has sketched out. So this dematerialization, or also Michael, dematerialization, increasing digitization, other societal functions that have come to the forefront and are seen by society as important in means of payment. So where do you see the similarities to cash, and where do you think one should go beyond what cash can at the moment?
So I do believe that sort of, having the equivalent of cash in a digital context is a main design goal. And that is something we see in the stocktake around the world. We also see it like in the BIS Innovation Hub. There is one of the projects by the Nordic Center is exactly on having a resilient payment means that can also work if you have connectivity outages. But it's a very ambitious goal, and I think realistically cash has some properties that CBDC cannot fulfill when it comes to sort of offline resilience and so forth. There's actually a very interesting Austrian National Bank, I'm not sure whether it's a working paper or what kind of, by Pichle et al. That sort of takes a critical view on this. But it is definitely a goal to sort of have this cash likeness. Then much has been said that it could do much more. And I feel sort of once you go through all the sort of the concerns that one has, should it allow for what kind of interest rate policies, but you always need to see it sort of in the context of these principles that you want to sort of limit the side effects on financial stability. You want to coexist with cash. You always end up that sort of, it's really about this payments mean this sort of just the cash likeness. That's sort of a bigger takeaway. Obviously, there are some central banks that sort of have put forth other motives, but I think sort of the general tendency I see in our stock takes is that it always circles in on sort of this basic retail payment needs.
And so maybe a question to Isaiah. So you mentioned these trade-offs, the hard ones and the soft ones, and they are very evident with cash. Where do you see CBDC fitting in these trade-offs, and would CBDC change some of these trade-offs or allow you to have a broader choice between options that you can achieve or goals that you can achieve with a CBDC compared to cash?
Yeah, so I should say, yeah, that's one of the areas where I see some clear technical restrictions in terms of what you can achieve in creating cash likeness in a CBDC. So if we wanted, for instance, a digital form of currency that was fully and permanently offline like cash, in the sense that you never communicate with the digital ledger. So we're not talking about, say, an account-based system where you periodically reconcile with your bank, or a ledger system where you eventually reconcile with a ledger, or one-sided offline transactions where the merchant is online and you're offline, but we're saying permanently offline transactions that are digital. There, I think there are clear technical restrictions that make that infeasible, because you can copy bits in polynomial time. And so you can't use the standard model of cryptography to secure such a form of digital money. So if you were to introduce something like that, you'd be introducing something, you'd have to use some sort of security through obscurity scheme. Now, of course, cash is in some sense a security through obscurity scheme. We've had other things like Mondex in the past, which were using security through obscurity. But in the current digital environment, to introduce a form of money that's fully and permanently offline, anonymous, it's not connected to an account, it never has to be reconciled with a ledger, and it's a digital object, I think counterfeiting becomes essentially trivial in that context. We have work going back to the 1980s from Chom on eCash that describes the problem here, and cryptocurrencies were essentially a solution to this problem, the digital ledger system. But it really is a fundamental one in computer science. So I think even central banks, if they want to really achieve cash likeness, there are points at which they can't go any further, and that's one of them. That's a real technical constraint. You can go further if you want to use security through obscurity, but my guess is that a lot of central banks won't think that's worth it, and they'll say maybe one-sided offline transactions are good enough, and we don't need to go that extra step. I also think in terms of problems that central banks encounter, one possibility is just the need to try to achieve certain type of societal and regulatory goals that private currencies might not be burdened by. And so then there will be a natural question of whether or not a regulation should be imposed on all currencies, so that it's not just the public currencies that face this particular burden.
Yeah, so I think it's very interesting, because what I realize is that cash likeness is meaning different things to different people. So you are a very fundamental view saying, well, cash likeness means that I'm offline all the time. I think other people say cash likeness means that cash has a zero interest rate, and if something is cash-like, it should have a return of zero as well. So Ulrich, what's your view on that?
Not much to add exactly. I mean, cash has different dimensions of properties, and on one side, one could say some of the properties just result from the constraints coming from the paper form, and when we move to digital currency, we don't have those constraints. So why trying to replicate certain things? But then there are also properties of cash which are nice, which like inclusiveness and resilience and privacy, and they have not been taken up by private digital means of payments for different reasons. I mean, privacy not allowed by regulation. Offline payments, there were large investments by the industry trying to get this working and making it work, but it was not taken up. We had in Germany the Geldkarte, and in other countries similar attempts of preloaded functionality on your card, bank card basically. But despite those big investments was not taken up, there was a lack of demand. Question, is it because people care about this only in theory or only when bad things happen with technological infrastructure, which doesn't happen often enough to be the basis for a business case for the private sector to offer it. And still, should we not do it if we have in mind a digital age where the use of banknotes and the fallback solutions that they offer would be significantly weakened because they would no longer be used? So from this perspective, I would say, yes, let's work on this as a central bank. Let's try to capture some of the properties, both in the domain of offline and the implied resilience, and in the domain of inclusiveness. So to see how, let's say, the elderly or the young or the homeless can also pay with digital currency in the same way as they can pay with cash.
So, Michael, in your presentation, what I didn't know and what I liked quite a lot is the idea of Visa, that it's cash is, there's a trend to a dematerialization of money. And something which you mentioned not at all is, how is this related to trust in the issue of money? And how is this related to transparency about transactions and transparency or information about money? Because a coin, you can touch a coin, and that's something many people say, well, I can touch a banknote, but I cannot touch a CBDC. So I think with this dematerialization, there needs also to be a development in society that accepts these dematerialized form of means of payment.
If I may come in here, I think that is already happening, right? That is a generational thing. For many, the touch point is the iPhone. For me, still money, but just I think, you know, this is really happening, and although not for like, I'm still on the side where I believe in cash, but I feel others are really different. Just a side thought.
Yeah, I can add to that. I mean, in our other paper, I make much of the story that money co-evolves with technology. So of course it's about economics and social coordination, but one cannot put technology out of the equation in a way, and the presentations today have shown it very much. So the different design options that Raphael had shown on digital currency were all now about different options how to design ledgers in the different combinations, and that is a major co-evolution with the technology. Katrin, you raised the question about the role of trust, and there is indeed a big issue about technology and trust as such. And there are many different dimensions, and there's a one dimension that I think Raphael mainly referred to, and that is indeed covered by the generational gap, so to say, that has to do with the skills, in this case the digital skills, to use the new technologies. If you have the skills to use them, you also feel you have at least more confidence in the technology. But generally, one could distinguish three dimensions in this relationship of technology and trust. The one is general reliability of technical systems. So the trust that the system won't break down, the trust that your money will keep its value in terms of not being hacked and so the double spending problem being solved, and cryptography works in the private systems, and public institutions maintain trustworthy operating systems. There's a different dimension that may be not so important in the context of CBDCs and private crypto coins, that is all aspects where technology relates to existential risks. So we have that, of course, with biotechnology and all these areas where people may fear from certain technological changes that these may increase risks like atomic energy and so on, that people are affected, and that of course can create a lot of resistance to adoption or to the establishment of novel technologies. And then there's a third dimension, which I think is the most important one in our context, and that is the trust in a system not being used for abuse. So it's a kind of trust that I can participate in the system, I can give in information, I can in the way I participate, I pay in a lot of information about myself and about my activities and transactions and that this information will not be abused by whoever has control over the system. And that, of course, brings in the issue of privacy, that brings in the issue, then again, of particular cash-like properties. And I think this, in our context, this is the main dimension where public trust can really be an impediment to adoption. And this is something that in all this design and finding an optimal design that is acceptable by the people, that serves additional functions, like as I mentioned, that will need most of the attention.
Yeah, thanks a lot. So now there are questions flowing in. So, and one is something which I also wanted to ask. So Isaiah was arguing that central banks battled earlier for having a role in payments, and now are battling in being relevant for fixing the unit of account. So the battle has shifted. You may argue that they have lost the, or you are arguing that they have lost the battle in payments to private money. Do you fear that they are losing the battle on the unit of account also at some point? Would it be bad? And there is a more concrete question from Samuel Morgensen. Can it be argued that central bank reserves are sufficient to ensure uniformity with respect to private money in an economy operating with private money only? So I think it's about, yeah, who's setting the unit of account, and is it necessary to have CBDC to not lose this battle on the unit of account?
So I'd say I suspect that central banks will manage to retain control over the unit of account. It's not clear to me whether they want to also try to make some headway in regaining control over the medium of exchange, or whether they're happy to let banks do that, especially with these a lot of two-tier CBDC designs we're seeing. It makes me wonder if, you know, essentially what central banks will ultimately end up doing is creating a modern version of the unit of account, or a digital version of the unit of account, and that's where they'll stay, and they'll let banks continue to take care of, you know, retail payments and so forth. So yeah, I'm optimistic about central banks retaining control over the unit of account. I really don't know what a world looks like where we have, you know, multi-currency stable coins or something else as a unit of account. It's hard for me to even speculate on what that would look like. But I guess that's where I fall on that.
Thank you. So we are now about 10-30 minutes to the end of the seminar. So let me start a final round where everybody can share their thoughts on what might money look like in 5 years. So Isaiah, you had a final slide saying, well, it's not clear whether CBDC will be adopted, where it will be strong. So what do you think? Will CBDC become a normal feature of money and payments? And what would be the share of private versus official money? So we know that private money, Raphael has shown his chart, private money is the predominant form of money nowadays. So is this something that will be left there? Is there a role for both forms of money? So please, yeah, I don't know, maybe we can start in the order of the presentation. So Michael, if you start off, and then, yeah, it should be 3 minutes, everybody, and then we can conclude.
Okay, being very short, of course, future, next 5 years, that's much speculation. But generally, I'm optimistic that CBDCs will take their place. Whether that takes longer than 5 years, I could presume, or not. The general picture for me is that throughout the history of financial innovations, we always had certain periods of immense, let's say, technological breakthroughs, and then the private initiatives that started to exploit these breakthroughs, but it was more in an unorderly, maybe chaotic, but very experimental and creative destruction mode, so to say. And after a certain time, when people start to more reflect on it, and that's typically the period when academics come in, not in the initial innovation, that's usually from the private people and from bankers like Ulrich mentioned before. But when academics start to reflect and systematize and condense these developments, and usually this also provides policy with a better handle on how to treat it. And then at some point, casually speaking, the system strikes back in a way that is absorbing major lessons and insights from these new developments. And I think that we are just about this. We will see this to happen within the next years. About the share of private monies, I think there will be a role for private monies, certainly, maybe for special purposes and then within specialized communities that could relate to trust within closed communities or closer communities, for example. And overall, I think that also the private coins and currencies also will have a role to play as a means of speculation. We didn't mention that, and usually we think of that in a more negative way, but I think it's good to have a means of speculation that kind, because that will also enforce some discipline on the public monies that out. So if people have an option to go out of the public monies because they do not trust that they will be sufficiently stable in value, then it's not a bad thing also to have private options where one can go to. And in that sense, it could be a means to keep the market for those general ledgers contestable.
Thanks a lot. So, Isaiah, what is your take?
So I like Michael's discussion of the dematerialization of money because I work on quantum money. So it's, the logical conclusion is that we're making money eventually out of photon polarizations and electron spins. And that's what I'm working on with OR. So that sounds great to me. Realistically, though, I think quantum money is probably, far off, if ever, an option for the construction of money. I could see, in the next, after we've already seen the introduction of some CBDCs, and so there we'll get some sense of, a take up and so forth. Do they end up being popular? Do they end up, regaining, the medium of exchange function and so forth? We have a couple of examples of that now in the Bahamas and China and so forth. And then we'll have the introduction of many more CBDCs in the near future with different properties. So we might get some sense of, what is it that makes for an appealing CBDC that gets adopted and what doesn't. It's not hard for me to see a world in which, essentially the retail part of payments is still more or less handled by private systems like banks and so forth, with the central bank retaining control of the unit of account. So that I think is it's very easy for me to see that picture. Then the other thing that makes me think that's even more likely is that I think central banks are going to be very worried about disintermediating banks by introducing a CBDC that in some sense is too successful. And so I suspect they'll take some caution there, and it's possible that will lead to weaker adoption than could have been possible had you introduced a type of CBDC that was really intended to very directly compete with private bank money. But on the other hand, I also think it's interesting to think about the possibility of a future in which we transition towards a CBDC. I'd also say both Michael and Raphael talked about resilience and redundancy, which I think is important. So I think it makes sense to have, a layered system where in the event of a cyber attack, you can move to cash, or you can move between two different types of, payment rails like a CBDC. So CBDC may play the role of adding redundancy to the system, while most, retail payments in normal times are through the private system. So I think all of those are realistic future options that I could see. I have a hard time. I think the one I think that is most likely is probably that private bank money remains dominant, and then also, so you have some additional private currencies that play some role too, but it's fairly small.
Thank you. So Ulrich, this must resonate with you.
Yeah, absolutely. So Isaiah puts it well. I think the question is how aggressive central banks want to move into this space. And if they want to move aggressively, I have absolutely no doubt that they can be very successful. Central banks have some unique, weapons, where they can conquer this market if they want to. They can rely, if the legislator grants it, on a legal tender status. They have fantastic economies of scale. they can offer credit risk-free money. You know, they can rely on the same business model as for banknotes, and basically say we finance all this just through the spread between positive asset remuneration rates and the zero remuneration of our liability side. So central banks can, and it is I think logical that they will enter this market, because the coexistence between private and public money worked well for a long time now, and there's no reason to you know, stay as central bank with 17th century technology being banknotes, in particular as Giro-based central banking has been there beforehand. And in the digital age, where the advantage of banknotes to allow for remote transactions is no longer there, you can also do it digitally. It is quite natural evolution of technology, which central banks should also follow. I mean, you said, you referred to 5 years, Katrin. 5 years is a bit tight, I would say. But if you say 20 years, you know, just to be on the safe side, then I think CBDC will be standard. There will be the challenge that Isaiah mentioned, to not be too successful, and then calibrating it. You know, the general idea is easy, but calibrating this and entering the market and specifying all the details is less trivial, but I'm pretty sure it will come here.
Thank you. So, and Raphael, you are probably the one who has the best overview of what's going on in that space. So what's your take? Will CBDC be a normal feature of money and payments
So
in
the
the Euro
one,
area globally?
if you're right with the best overview, then let me certainly say that I'm the least certain about developments. And you know, you're saying 5 years. Let's think 5 years back. That's March 2017. That was before the first Bitcoin boom. That was before we had major stablecoin arrangements. That was before we had a pandemic. That was in a very different geopolitical backdrop. So what am I to predict the next 5 years? But I think sort of generally what we can definitely say is that there is so much heterogeneity in approaches around the world. And we should see, right, there's already first projects. Some are going ahead, some are actually stagnating. We had one CBDC that had a month-long outage recently. We've seen very successful other payment initiatives like PIX in Brazil. The BIS just published a bulletin on this, where I think 60% of the population is now using that system. And from that, we get a lot of learning, and that goes back to the issue of calibration, right? Sort of the jurisdictions have very heterogeneous economic circumstances, legacy systems, and policy goals, what they want to achieve. And for some, like a CBDC seems sort of the way to go, but the CBDCs won't be alike, right? Some will have, you know, very different goals. And I think sort of from that perspective, a prediction would be that we will definitely see CBDC issuance in some countries, and an ongoing calibration towards this goal. And I think sort of in advanced economies, it is going to center on what Isaiah emphasized, sort of this fallback option, this visible anchor of the central bank, but not the dominant form of payment.
Thanks a lot. So I found this exchange, the presentation and the discussion, very stimulating. I think it gave a deep foundation in economic thought, and I found it very useful to look back across centuries and to look at these general principles. So thanks again for your presentations and for the discussion, and thanks to the audience for the question. And with that, I would like to hand back to Ernest.
Thank you very much, Katrin. This concludes our e-lecture on conceptions of money in the digital age, starting from various conceptions of money in the very, very long run, in the very, very long history of economic thought, and in the history of money and banking. I cannot resist but draw a few personal takeaways that I take along. We found first that many of our considerations with respect to the consequences and trade-offs related to modern digital forms of money are not entirely new. but that digital monies offer many new possibilities, which also create new trade-offs and new choices to be made. The point was also made that the specific features of digital forms of money, including public CBDC, affect their attractiveness for users and may decide on their success or failure. The concept of trust and general acceptance was mentioned, which is of course particularly important for the acceptance of fiat money, and all the more so if it is in virtual, digital form, with all the new opportunities, good and bad, this offers. Recent geopolitical developments may also have emphasized the aim for resilience and robustness of money and payments in times of crises. This would, among other arguments such as freedom of choice and inclusiveness, also support the notion that the parallel existence of various forms of money may be useful in terms of robustness. Finally, I found very interesting the last exchange on the future. To me, it became obvious that it seems quite difficult to forecast the future evolution of money, which reflects the general trend to very fast change in many areas of technology, in our economies and in societies. Still, the notion was shared, it seems to me, that the dematerialization of money will continue, that CBDCs will be adopted in many countries, maybe not in 5 years, but in 20 years, as Ulrich pointed out. But private payment systems and monies will continue to exist in parallel. Central banks may, I think this is also an important point, in fact decide on purpose not to exploit the full possible scope of CBDC with the aim of preserving the private sector's functions in payments and in financial services. Let me, to conclude, thank Katrin, Michael, Isaiah, Ulrich and Raphael for your excellent presentations. I learned really so much today and the lively and stimulating discussion. Thanks to all in the call today for your interest. As usual, we will put the slides on the SUERF website after the event and circulate a video replay of the lecture in the next few days. Thanks to all, bye-bye, and take care.
Bye-bye, thanks.
Thank you.